Hey, good morning, everyone. My name is Thomas Purcell. I'm with URL Insurance. Thank you for taking the time out of your busy morning to hop on this very informative webinar we're about to put on for you. This is a selected group of individuals that we kind of handpicked that we thought would be a good fit for this program, and people that, quite frankly, we feel try and think outside the box when it comes to healthcare solutions. So that's what we're here to talk about today. This is a new relationship URL has developed over the course of the past year. I've been very impressed with our experience, not only with the quoting and onboarding, but just their concept, and a lot of what you're going to hear, I think, from our awesome guest we have today is aligned incentives. And it's just really powerful what we think they're doing. And it got to the point where we're ready to kind of introduce this to some of our select partners. So that's what we're here to talk about today. Like I said, I'm Thomas. I'm with URL Insurance. I'm the VP of our Health Plan Options Department at URL, but we're a wholesale FMO brokerage. So we do life insurance, annuities. We're big in the Medicare space, and we do individual under 65 health insurance as well as group employee benefits. My guest today is JR. JR is with Crumdale Partners. I'm not going to steal too much of his thunder. He's got a lot of great stories to share, both personally and professionally. So, JR, if you don't mind introducing yourself, giving us a little background before we get into this. I don't want to take up too much more time. On the right-hand side, there's handouts. There's links to our website on the right-hand side of your screen. There's a Q&A section too. If you have any questions, feel free to type those in, but we have a lot of content that he's going to be going over today. If we have time at the end, we'll address any questions. If not, I'm super happy to follow up with everyone attending personally, and JR's on the same page too. So,
yeah, absolutely. I
Yeah.
really appreciate you bringing us on board here. Yeah, my name is JR, John Rawlings, whatever you want to call me. I've been with Crumdale for 2 years now. I am a regional sales director here. I spent the last 10 years prior to coming over to Crumdale, actually up in the Northeast, for anywhere from Greenwich, Connecticut, really up, doing portfolio analysis and portfolio management consultation for financial advisors. So kind of bringing that unique background into the employee benefits space has been a really awesome transition for me. I've really enjoyed what we're doing. And like Thomas said, please utilize, I don't know if you can talk or or if it's just through the Q&A, but this is meant to be informative and conversational. So if you do have questions at any point, it's an idea you want me to flesh out further, this time is yours. So please just stop me and let me know. But yeah, I'm very excited about the partnership that we've had with Thomas. We've been working together now for roughly half a year. What you'll learn today about our program is we are very thoughtful in the way that we roll things out. So, and the relationships that we bring on board. This is not something that we really make available nationwide, or not available to every single consultant out there, because as Thomas had alluded to, not only with the vendor partners that we bring on board, but the preferred consultants that we work with, we want to have a mutual incentive with them, right? Be able to help you achieve your goals, which at the end of the day is helping your groups get to the spot where they want to be. So do you want me to just jump into it from there, Thomas?
Yeah, that works, man, for sure.
Cool. So, and 47 slides here, but I'm not going to touch on every single one of them, just to get that out of the way. And a lot of them I only spent like a minute or two on. So first off, I just want to first just start by saying a little bit of an agenda here. And I know it's going to be, redundant to a lot of the people on this call, probably everybody, but just the current overview of the marketplace. And the reason I want to touch on that is because it really helps set the stage for the second part of this, which is who we are and how we fit into that marketplace, and why we chose the people that we chose, and then why we do the things that we do to help drive down spend. And really for us, it all starts here, which is what first and foremost groups are looking for. Over the past 2 years since I've been here, I've had hundreds of conversations with employer groups when I've had the privilege to be tapped in through my preferred consultant network. And time again, you hear the same two things when you ask an employer what they're looking for from their healthcare plan. The first thing is I want to have great coverage. I don't want disruption. I want to be able to access the same doctors and provider network that I am today. And then the second thing is I need it to be affordable, right? I don't know if anybody knows this, but last year, the average increase from a BUCA carrier was over 20%, right? So the idea of being affordable and working with someone that can actually help you do that and is incentivized to do that is becoming more important than ever before. When trend increases are upwards of 10%, and the current trend in the healthcare space is making that number higher and higher every single year. And so our question to groups is, well, especially if you're in the model that you're in today, is that conducive of you achieving both of those things, right? And so the thing that I educate groups on all the time is what got passed back in 2010 when the Affordable Care Act got passed. It's a little rule called the medical loss ratio rule. And what that did was it was actually supposed to benefit the consumer, the employer, by restricting the percentage of profits that a carrier can make off of a group's premium to only 15 to 20% of a premium. And so sounds great in practice. However, what has ended up happening is it's created a framework for any carrier, not just fully insured, level funded, or ASO model, but any model out there that's getting paid as a percentage of premium. It's created a framework for them to know how to increase the money that they're going to make off of your groups every single year. All they have to do is raise the premiums, right? If they want to increase this blue piece of the pie, all they have to do is increase the pie as a whole, right? And so when we're asking groups, why are you with Blue Cross, or why are you with Aetna, or why are you with Cigna, or why are you with United? And they say they want good coverage. Great. You can still have that. And a self-funded model, you can still have that type of coverage, get access to wide, big networks. But you can never, groups wondering why they're getting the rates that they've had, and why they're actually not being able to reduce their out-of-pocket spend and reduce their own medical premiums. It all drills down to that. The arrangements that you're in today aren't geared towards helping you do that. The incentives just aren't aligned. And so in our model, which we'll talk more about today, we think that is the number one problem, and the biggest problem that no one is talking about, which is how people are getting paid. So if you can understand in the context and the frame of this conversation, that everything that we're going to talk about today as it relates to us is we get paid as a percentage of savings, and we sit on the risk for every single group that we bring into the program. And so what that means is we actually have a direct incentive to help drive groups' premium costs down every single year. And so everything we do is geared towards that. Every decision that we make is geared towards savings, while also still making sure that your groups have access to great coverage by renting networks like Cigna and Aetna. Huge networks. So your disruption, the perceived disruption of not being able to go to your doctors and providers, no longer there, right? But in our model, instead of taking a percentage of your premiums as our profit, we're actually taking a percentage of the savings. So if you don't save, we don't get paid. And as a matter of fact, if you actually have a max cost that's higher than what we're saying you should be at, since we sit on the risk, we would be the ones that have to pay for that out of the pocket at the end of the year. So what we've done is we've identified that as the real problem, and then we've addressed that problem. It's not the ability to carve out drugs. It's not the ability to actually tinker with your plan designs. All of these things that groups, the buzzwords that we're talking to today, all drills back to this. Why can't you do those things? Well, because the carriers and the models that you're set up in, if you were to do those things, it would be at the detriment to those individuals. And so it's when you look at that from the context of understanding that, it's easy to understand why over the last 25 years we've seen the average premiums go up 300 or 400%. Why the worker contributions have gone up 300% over that same time frame. We've seen the average family deductible creeping up towards $4,000 today. And this is a big reason why I shifted over to this industry, is I started getting tired of helping the top 1% get to the top 0.5%. And I wanted to help the people that actually need it. Because you don't need to work in finance to know that if you only have $5,300 in your checking or your savings account, that's no longer savings. That's your safety net, right? And that's the reason today why medical debt has become the number one cause of bankruptcy. And what's crazy about that statistic is 66.5% of people that went bankrupt because of medical debt had health insurance. And so those are the problems that we're trying to address in our model, right? And when I educate groups on this, they always come back to me and they say, well, if we're the ones, if we're the ones paying for it, the carriers must be getting hosed too, right? Wrong. I ran this chart since 2010, and since 2010, you can see that every single publicly traded company that is in healthcare over this time frame, United's up 2,400%, Humana's up 500%, Cigna's up 600%, right? So they're the ones that are making money off the back of your groups and off of their employees. And so what we've really seen is a shift right now and a demand for change. The first time that this started to really happen was in 2022. We saw 2/3 of employers asking for things beyond just access to quality providers. As a matter of fact, more transparency on costs and reducing out-of-pocket drug expenses represented almost as much of what employers wanted as access to quality providers, right? So people are becoming akin to this information and wanting to do something about it. So employers are screaming that they want a solution to that problem. And why do you think they're doing that? Well, because employees are saying the same thing. This is a study that I pulled from Forbes after the Great Resignation. And what we saw is the number 2 reason why people quit their jobs through 2022 were because they were seeking better benefits. And when you drill down into why, it's twofold. The first one is because of it translates to every single one of these other options. It's all to pay. Your benefits are costing you too much that it's actually detracting from the income that you're making. Or on the flip side of that, your benefits aren't rich enough, so you're not utilizing them at all. Right. So today we've seen this shift where people realize that this is a problem, employees do and employers do. And not having a solution for that really puts yourself as a consultant susceptible to getting rolled by people that are having these conversations. And it also puts yourself susceptible to having an opportunity to win new business. Right. And so that's where we come into play. Last year alone, with my consultants and a few other partners that I've worked with internally here, through conversations that I've had, I was lucky enough to be a part of 30 BOR takeovers, talking about these problems and talking about the solutions. And so for us, when we thought about what the right solution was, we've been around since 2015, and instead of taking this kind of ready, shoot, aim approach, we took a ready, aim, shoot approach, like you should, right? And so what that means is, the reason that this is just being brought to your attention today is because we worked closely with our first group of preferred partners and our first group of employers to find out what they were looking for. And these 5 buzzwords came up time and time again: cost, transparency, accountability, control, and flexibility. What we found is that groups knew these words but didn't know what they meant. And furthermore, they didn't know that how to utilize these things to impact their costs. But at the end of the day, they knew that they needed these things to drive down their cost. Take transparency, for instance, access to data. If you're fully insured through an ASO model, having access to data is one thing. Knowing what's driving your spend is one thing. But being able to work with someone that can actually identify what's wrong with your data and then try and create a program that's going to help drive down that individual problem is a totally different thing, right? Having access to data is just a big buzzword today. Transparency is a big buzzword today. That if you don't, we want transparency, we want our data. Well, why do you want it? Right? Just because you want to know that you have a cancer patient that's driving your spend, or because you know you have a cancer patient that's driving your spend, that is taking drugs that are being billed towards medical, and having a J-code strategy that you can put in place that can actually take those drugs and get them starting billed as a pharmacy claim and try to reduce the out-of-pocket spend for both the employer and the employee, right? That's totally different than just understanding what's driving your spend. It's understanding what's driving your spend and understanding how to use that data to actually impact savings, right? And so you can say the same thing here for accountability, control, and flexibility. Working with particular vendors, right? Understanding the terms and conditions that you need to set with them, and having flexibility around programs that you're putting in place. Putting in a diabetes program for a group that has one person with diabetes makes no sense, right? So adding point solutions that just increase your fixed cost but don't actually decrease your overall cost. That's the difference between working with someone that's going to have an incentive to actually put things in place that impact your group's individual spend, and working with someone that's just focusing on these topics. And so when you look at really the difference between the fully insured model and even ASO model or level funded model, what we say all the time is that we don't want to make what's already simple complex, because that's what the BUCA carriers are doing. I talked to I actually was, I was very blessed in the fact that I was able to write a group for 2-1. It was 717 lives, and they were with Blue Cross in New Jersey. And so this group that is 717 lives, it's Blue Cross in New Jersey, had no idea that they have a PBM and that they have a TPA, a PBM named Prime and a TPA named Anthem. They thought it was all Blue Cross. And technically they're right? Technically Blue Cross owns all of these pieces. And going back to the slide number 1, it's easy to understand why they want you to think that, because the more control they have, the easier it is for them to impact their own bottom line, right? A group that's with Blue Cross in a fully insured model makes 60% more profit for Blue Cross than a group that is fully insured, that is self-funded ASO through Blue Cross, right? The more unbundled you get, the more control Blue Cross loses, the less profit they make. In our model and every other self-funded model, it's the reverse, where the more you take away from, the more control you take away from the carriers, the more profit you can make, right? So this is just to show you, and this is what we tell groups all the time, is like, look, this is all of these things, all of these moving parts are necessary cogs for your healthcare plan. You need a TPA to administer your claims. You need a PBM to administer your pharmacy and to create your formulary. You need a network. You need to have stop loss. You need to have advocacy programs. Blue Cross, Cigna, CVS, Aetna, United, they've all just integrated it. And we think that's the one thing that they've gotten right. To have a 700 life group that does not know they have a PBM or a TPA, I mean, that's fantastic marketing by Blue Cross. But what we educate groups on is the fact that, yes, you have these things today. So don't get nervous about the idea of moving towards something where you're now having control over these parts that are necessary in your healthcare plan, but having control over how you're actually utilizing them, right? So in the Cromdale model, all we've done is we have unbundled this and then repackaged it back up, right? So we've combed the 180 plus TPAs in the country. We've combed the 50 plus PBMs in the country. We've combed the multiple networks in the country. And what we've done is we've worked with those partners that can achieve these things, but under that same umbrella that we talked about on slide 2, savings, right? Is the TPA that we're working with, is the PBM that we're working with, is the advocacy partner that we're working with, are they going to help us allow to get to the lowest net spend? Because the lowest net spend to your groups is our highest net profit. And so when we are choosing these trading partners, we're choosing them all under that umbrella of savings. Maximum savings with minimal disruption is what we like to call it, right? And so that's our model. So instead of you having to go out there and comb the marketplace, we're doing it for you, and you can feel comfortable knowing that we're going to pick the correct partners, because when we pick those partners, it aligns with what you would be trying to achieve with that same partner if you were to do it yourself. And you can know that it aligns, because if we don't do it, we would lose money on that group. So I just want to take a quick second. Again, this is probably going to be very high level and mundane to a lot of you here, but just want to take a quick second to, go over the differences between self-funded and fully insured, because at the core, it's really the same thing, right? All fully insured has done is it has lumped together all of your costs into a maximum guaranteed cost. Self-funding breaks in your costs into two barriers, your claims cost and then your fixed costs, right? And then the beautiful part about self-funding, and same thing with level funding, is that at the end of the year, if you run well and your maximum cost is 1.4, where in fully insured, that would be your guaranteed cost, and you run under that maximum cost, you get a surplus. So in this fully insured model, if you have a $1.4 million premium, your claim spend is $1 million. Your renewal you're going to get is not really conducive to how well you run, because they're going to, really not give you the data to understand that. And then subsequently, you do not get a surplus. In the level funded model, same thing would happen here, except you would have to split this surplus with the carrier. In a self-funded model and in our model, if you run well and you have a surplus, you retain 100% of it. And then because you have the data and we're running through that data with you and with your groups, we'll actually tell you your renewal and why you're getting that renewal down to every single number, right? And so in our model, we're actually utilizing the data to help you drive down, to maximize your surplus and drive down to your lowest renewal, right? So, but this is what scares people, is a bad year, right? And, I'll just share another quick story here. It's a group down in Texas, which is my primary market that I cover. They were in Dallas. This was a 61 life group, and they were with a fully insured carrier down there. Their name's Memorial Hermann. And they had a cancer patient hit their spend. It was a $3 million claimant, and they got an 87% fully insured increase because of that cancer patient. And this group came to us looking for an off-cycle renewal, and they were nervous about what their renewal experience would be like if they had a bad year. And I had told them, I mean, could anything be worse than the experience that you just had in your fully insured arrangement? You had an 87% increase. That's the highest that any of my underwriters had seen here from a fully insured increase ever. And I have people that work at our company that underwrite, that have worked for Blue Cross, Aetna, Cigna, you name it, right? And so when we have these conversations, we want to help people understand that this is no different, that the renewal cycle will be no different in a bad year with self-funded as it would be fully insured, because you have stop loss. You have stop loss coverage that will help have the same type of maximum cost that you had. So in this model, if your claim spend was 1.9, in our model, the group's maximum cost would still be 1.4, and that $400,000 that you ran over, we would be on a hook for a portion of that. So again, that goes back to our incentives to make sure that you look more like this instead of looking like this. In this model, you're getting your surplus back. In this model, the only difference is you get a bad renewal that's not going to be any different than fully insured, right? And so what we have done to actually combat that, what we found, again, being thoughtful and rolling this out, when we talk to groups just don't understand stop loss. And you can try to explain it till you're blue in the face to a head of HR, and they're just not going to understand it. So instead of trying to help them understand stop loss, all we've done is build a consortium. And so we do a ton of business for groups that stand alone and self-fund and come to us, like this 700 life group. They didn't go inside of our consortium because they're big enough and understand that they are big enough to self-fund by themselves. But for groups that feel like they're too small to self-fund, regardless of how well they're running, instead of trying to explain to them stop loss and max cost, we've just said, okay, well, let's put, instead of you being by yourself, let's put you in a pool of employers that are also self-funding through us. And in that pool, you've now, instead of being a 61 life group, or we write down to 25 enrolled employees, a 25 life group, you've become a part of a 250,000 life consortium. And so for us, we think that this is the best way for groups of the size that want to pull together for a couple of reasons. I mean, there's a large conversation about captives versus consortiums. And when we rolled this out, we looked at captives, and we're actually on the precipice of launching our own captive today because there's benefits there, benefits that outweigh those of a consortium, like investing in yourself as a company, investing in your health plan as a company. In a consortium, what we just found is that a lot of groups that want to have an impact on their bottom line don't want to be an expert of their healthcare plan, don't want to be the owner of their healthcare plan, which is what happens when you in a captive. You also don't have upfront capital, so you don't need to fund a captive layer. And so there is no upfront capital that you would have to put down in order to be a part of this pool. And then the last part is, like, you actually have your own individual stop loss policy. So every group is individually underwritten, and then the consortium as a whole is underwritten, right? Now, what's unique about our program that's different than any other pooled arrangement in the country is that in our program, for every single group that's inside, whether it's in this pool, in this consortium, or outside the consortium, we do all of the cost containment, right? Why is that important? Because I'm sure a lot of people on this call are in the Northeast area, right? Just understanding that Thomas and his team is out in the Lancaster area, or Harrisburg, excuse me. So I run into Pareto and Benecon all the time, and they are very, very good at what they do. But what they do is renewal management. And so what I mean by renewal management is they just try and stack as many lives as possible, and they've done a fantastic job at doing this, to use stop loss pooling to then impact your renewal, right? That's managing the renewal. That's not managing the cost. In our model, and that's why if you go to them and ask either one of them for a standalone self-funded quote, their answer will be no. I mean, I ran into a group down in Texas that was about 1,500 lives that went to Benecon, and Benecon told them, sure, we can write you, but you have to come inside of our consortium. A 1,500 life group does not need to be inside of a consortium, right? They can standalone self-fund by themselves. But the point in that story is just the fact that that's the only way that Benecon can actually, that's the only thing that Benecon themselves can do to contain your costs. In our model, we're the ones that are on the front lines trying to do things that we'll talk about momentarily that actually impact your claim spend. And that's our difference is in our model, we are doing everything, the things that we're doing for group 1, we'd also do for group 10. And if there's group 12 that's here outside, that's standalone self-funded, we're doing the same thing for them as well too. So in a captive model or another consortium model where the cost containment is incumbent upon the group to administer the cost containment, those models have no control over what group 1 through 10 do, right? So you could have a pool that's not running well because you could be doing all the right things individually to make sure that your group is running the best that it can. But because groups 6 through 10 are doing nothing, you have a negative experience. In our model, we're doing all the cost containment for every single group. And so instead of trying to manage the renewal, we're managing the claims. Because if we can manage the claims for any individual group and bring them down to their lowest net individual spend and do that for every group inside of the pool, then we should help that group get to their own individual lowest net spend. And if you're doing that for every single group, then the pool as a whole should be running as healthy as it possibly can be. And instead of relying on you as the consultant who is out there trying to retain business, bring in new business and manage the day-to-day for these accounts, instead of you having to do that, we're doing it. Instead of the employer having to contact their employees to do that, we're doing that. Instead of the employees having to change the way that they digest healthcare and consume healthcare, we're doing that, right? So in our model, we're doing that for every single group. So what does that mean? That means that this stop loss pooling for us is a backup plan. That's not the way that we manage the renewal. That's the way that we manage groups 9 and 10, because the statistics will tell you no matter what you're doing to manage your individual spend, 1 out of every 4 to 5 years, you're going to have a bad claims year. And so when you have a bad claims year, what a consortium allows you to do is subsidize your bad year by the groups that are running well. And if the groups that are running well are running as well as they possibly can, you'll have more percentage points up here to spread out down here. So that's those are really the differences between a consortium and a captive, but it's really important to understand the differences between my consortium and another consortium, right? Because I mean, one of my best partners down in Texas said, I find you to be more dissimilar to Benecon, who's a consortium, than Benecon is to Pareto, who's a captive, right? Because Benecon and Pareto's approach is the same. They just use stop loss pooling to minimize the risk. You can bolt on programs as an additional fixed cost that can help drive down the spend, but instituting those programs falls on your shoulders and falls on the group's shoulders. In our model, those programs are being done in real time by us. So we are more dissimilar to another consortium because we're doing the things that neither of these two groups are doing. And I can say that for just about any other pooled arrangement in the country today, because there is no other pooled arrangement in the country or any other standalone self-funded plan in the country that is administered by someone that is getting paid as a percentage of savings and sits on the risk. So it is incentivized to help you drive down your spend. So then in our individual model, as we start talking more about some of the cost containment that we're putting in place, we'll also talk more about some of the problems that we're seeing in the marketplace and then how we're addressing those problems, right? And this is all you're looking at here. I'm sure a lot of you have seen this before. If this is an employer group's $1 of their healthcare spend, where is that $1 being allocated to on an annual basis, right? And so what this story is telling you is that 72% of your medical spend is coming from shock claimants and coming from pharmacy. And 80% of that spend is being driven by 20% of the population. And then when you drill down deeper to pharmacy, only 2% of your scripts are driving 55 to 65% of your volume. And so when we thought about putting a program together, we thought about addressing these problems, right? But the first thing that we wanted to talk about is addressing, like I said in the beginning, being able to maximize the savings while with minimal disruption, right? And so I'll bring you back to this. Like, we wanted to be able to address these things for groups while also doing it in a way where it's minimally disruptive to them and they can operate the same way that they're operating today. And so I'll reiterate what I said earlier, which is we truly think the one thing that these carriers got right is the vertical integration, right? Bringing you back to that 700 life group. To have a 700 life group not know of the trading partners that they're working with inside of the spot on their bottom line that represents the second biggest item on their P&L is crazy to me, right? That's just nuts. And so in our model, we wanted to mirror that, right? We wanted to let groups look and feel like they had that same integration. So they don't have to know those people either, but they know that they're working with someone that when they're picking these necessary partners are picking them under the understanding of cost containment, right? And so that's the way that we have done this, is that we have vertically integrated ourselves. However, we've done it in a way where it's contracting with partners and creating contracts with those partners that are beneficial to your groups, right? And so in our model, we like to say, and if we started to work together, you would start to understand who our TPAs are, who the stop loss carriers we use are, that share in the risk with us, who the PBM is, who the PBMs we utilize are, right? But we like to say, from a group's perspective, we want them to be nameless and faceless, because in our model, we are the program manager, right? And so from your standpoint, if you have issues as the agent or your employer has issues, they can do one of two things. They call you or they directly call us. And so every group has their own individual Crumdale Partners account manager and account service coordinator that lives underneath them, right? And so when that happens, you can see that instead of having an issue with instead of having to call the TPA or the PBM or telemedicine, they're directly contacting us. Instead of having to call Cigna or Aetna, they're directly contacting us. And so we're the ones that are then going to these partners and getting those issues resolved. And then from an employee perspective, they call Crumdale advocates. And this is my favorite statistic about our program, because it attests to maximum savings with the most minimal disruption. Our client satisfaction rating when contacting advocacy is 98%, right? So this integration is working. We want the employees and the employer to feel like, first off, they know they're renting a big network, so you can share that with them and say anything that's in Cigna or Aetna you have access to, but your point of contact is Crumdale, right? They're the one administering your plan. And then if there's issues, high-level issues, checking claims, eligibility, trying to find a provider that's a network that's high quality, lowest cost for your employees, they're all contacting Crumdale advocates. And then we do have 24/7 telemedicine through Recuro Health, and that's just for standard illnesses. I mean, I used it last year when I had strep throat. Didn't have to go to my doctor, had a 5-minute call with Recuro, and I had antibiotics that cost me 56 cents within 30 minutes, right? So for your employees that don't want to have to go to their primary care physician to go get a swab, because you're just telling them what you're going through, you can actually work with telemedicine, and those are actually accredited doctors that are available 24/7 to help you with that. So a lot of benefits to the employees, and it's enhancing that employer-employee experience. And again, mirroring that vertical integration. Want to reiterate, we're renting the Cigna and Aetna networks. We can also do RBP for groups that are trying to drive down to an even more comprehensive cost. We don't do a ton of that just because a lot of the groups that we bring in are coming from fully insured and level funded. And they don't want to take that step, that leap of faith, if you will, with the RBP space. And then just to give you an idea on what the cards look like, because this is big Thomas and I, we met with a couple people last week. We got these questions a couple times. What do your cards look like, right? And our cards are laid out in a pretty easy way to understand, and a very palatable way for both the employer to understand, the employee to understand, and most importantly, the provider to understand. So you can see here in a big blue line, big blue bold, For providers, they call Crumdale Advocates, or they call HealthCom, the TPA, right? So you're renting this network, Cigna, could say Cigna, could say Aetna. This is the network that you're utilizing, but you need to verify the benefits through the TPAs, right? And then for members, they're calling Crumdale Advocates. For members, again, they call Crumdale Advocates. So very easy for them to digest and consume from an employee standpoint. And then the really unique thing that we're doing here, because we are the ones that are actually sitting on the risks and underwriting groups in states where it's possible, we can completely remove the corridor for employees or for employer groups. So what that allows us to do is actually max fund. And what that means for your employees is actually level fund. So from a billing experience, it will mirror their experience that they're in today. So they don't have to, as you would in a traditional self-funded model, pay as you go, get the claims registers as they come in and pay them on a weekly basis. In this model, what you'd be able to actually do is have that same experience that your HR department or your finance department is having, which is just, here's your monthly bill. It's split up between your fixed costs and your claims costs. Regardless of what claims come in, you're only going to have to pay that monthly bill divided by 12. So that experience for your employers is going to be mirrored to what they're in today. So again, you could see very thoughtful in the way that we're rolling this out, because we want to minimize the disruption to what they're doing. We want to make those barriers of entry that are traditionally there in a self-funded model removed. We want to give them all the benefits of self-funding, but also have a plan that is administered like a fully insured or level funded plan, right? It has the looks and the feels of fully insured with all the benefits of self-funding. So some of the unique things that we are doing from a cost containment perspective is, first off, contracting with TPAs, right? And a couple of things that are hot button issues today all the time that we discuss daily are the incentives that your TPAs have, right? Who is their real client? Is it your group or is it the network that they're renting, right? And so what we've done in our TPA arrangements, which is different than the ones that you are in today in the fully insured or level funded model, or even in a unbundled self-funded model where you have to go out to a TPA, is that they would themselves have to give you their Ben admin agreement, and you'd have to sign on the bottom line. In our arrangement, we've flipped that, where we set the terms and conditions for our TPAs, and let them just do the core things, right? Issue ID cards, processing claims, enrollment and eligibility, all of those things, right? So why that is big, right? Because the average TPA today in an independent TPA arrangement, they have what's called an auto adjudication level. And the average auto adjudication level for an independent TPA today is $50,000. And what does that mean, right? Well, that means that any claim that falls under that $50,000 threshold, that is just going to be rubber stamped for approval. And so that means that it's going to get no audit whatsoever. Coming from financial services, finding out that there was a huge industry that does their own audit, which is called a TPA, was mind-boggling to me. But that's what happens today, is TPAs audit their own work, and then they come back to you and say, here's what we found, and you just have to take their word for it, right? That's why Aetna got sued by Hines last summer. Their auto adjudication levels were at $100,000, and then over a 3-year time frame, as they started to dig deeper, they realized that about $1 billion, a couple $1 billion worth of claims were just rubber stamped for approval that got no audit whatsoever and should have never been claimed or paid. So in our model, instead of setting the auto adjudication at $50,000 or $75,000 or $100,000, I worked with a group up in New York that came over to us. They had an independent TPA auto adjudication level at $275,000. The TPA had an audited claim in 2 years. And so in our model, instead of having it start here, we have it start here at $5,000. And then we audit every single claim that comes through over $5,000 after it's being audited by the TPA, right? And so we call that a bi-level audit of claims. So instead of taking the TPA's word for it, we do a secondary audit of those claims. And by doing that, on average, annually, we're reducing claim spend anywhere from 5 to 7% for our employees. We last year identified a duplicate claim that was $40,000 for a knee replacement surgery that was billed twice. And so we went back to the hospital, and in a TPA arrangement, that would have just been rubber stamped for approval. and it might have gotten auto adjudicated next year or 2 years out after they realized that it was wrong, but that's forever going to be in your claim spend, right? And that's forever going to be in your premium for the group. So in our model, we were able to identify that, work with the hospital and say, what gives here? This person get their left knee and right knee replaced on the same day, and their left knee cost $10,000 or $10 more. And the hospital, of course, said, no, I'm sorry, that was wrong. And they removed it for us, right? And so the power of us doing that bi-level audit and catching the things that the TPAs aren't catching is huge. For that, I just talked to our chief of staff who's working with me on this large group, and she has already, for this 2-1 group, combed through 500 claims. Nuts. And she was able to find somewhere around 50 duplicate claims. So, I mean, it is nuts when you're seeing just a fraud, waste, and abuse that's coming through for these groups that is otherwise just being completely neglected. So in our model, instead of neglecting them, we're actually identifying them and acting on that. And why are we doing that? Because, again, it goes back to our incentives. In our model, the lowest net cost is our highest net profit. So if we don't do that, then your group's going to run poorly. And if your group runs poorly, then we're the ones that have to pay for it out of pocket at the end of the year. So the next big part here is what we're doing on the pharmacy side. And this is becoming a bigger and bigger issue every single year, right? You see here, pharmacy, specialty drugs make up 2% of the RX volume, but 53% of the drug spend. And moving into next year, that's creeping up towards around 65 to 70%. Since 2000, the approval of specialty medications has increased by nearly 600%. So they're just getting approved and approved and approved. And the big drugs, the drugs that are really driving costs, these orphan drugs, we've seen 700 of them pass since that drug act got passed alone. And you can see the average annual price for specialty medications now is approaching $90,000. And so for us, being able to control this, which is still it's represents such a small amount of what's actually the people on your plan, but it's driving such a large percentage of your overall premiums today. Being able to control that is of the utmost importance to us, especially since we're sitting on the stop loss, right? So identifying partners and creating contracts that can address doing things like alternative sourcing was a key to us in this space. And so that's why like I had mentioned earlier, that we don't just do groups inside the consortium. We also do groups outside the consortium. We also do a ton of things with our, we do a ton of business with people that just want to use our PBM contracts and do PBM only business. And so where they're saying, look, I'm with Cigna Direct today. So I have a Express Scripts contract. It's terrible. I get no rebates back. I get terrible discounts. The optics are awful. I get no minimum guarantees. Can I just exchange my Express Scripts contract with Cigna with your Express Scripts contract? And we can say, yeah, we can do that. And when we do that, it's saving groups around 45% on their pharmacy spend. And the employees don't even know it's happening because we're doing a card roll for them. We're just replacing the PBM's contract, keeping the same PBM, just upgrading the terms and conditions. And so for us, we have realized that there are massive benefits with working with big 3 PBMs, right? The rebates that you're getting you're never going to get rebates that are better than rebates that you can get with the big 3 at the core. Because if you don't work with them, you have to go through a pass-through PBM that then has to go through an aggregator to get rebates. And so when they go through an aggregator to get rebates, you're taking more and more money. These aggregators take a portion of those rebates, and then another aggregator will take a portion of those rebates before you get the bottom line rebate that you can then pass through. And so pass-through PBMs that say, okay, we pass through 100% of our rebates. Yes, that's true. But if they're a smaller PBM and they have to work through multiple aggregators, the rebate with the big 3 is going to be here, and the rebate that's available to them is going to be here. Right. So what we've done by becoming one of the largest coalitions with Express Scripts in the country is be able to create a contract with them where we can get top line rebates and pass through 100% of the rebates through the Express Scripts contract. But what we can't do with them is alternatively source. And so understanding what we just went over, what's driving your spend, specialty drugs, being able to alternatively source these drugs is going to have a huge impact on savings for groups. And so what we did is mirror the terms and conditions that we have with a big three with what is probably now the fourth to fifth largest independently owned PBM in the country called Welldyne. And so they allow us to do everything that a pass-through PBM can do, carve it up, look any of these things, patient assistance, wholesale specialty sourcing, copay cards, international importation. We can do any of those things, but it's with the framework of a big three contract on the front end. So the rebates are going to not be as good as the ones with our Express Scripts contract because they still have to go through one aggregator, not multiple, but it's going to have really, 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 really great rebates that you can pass through 100% of those to your groups, minimum rebate guarantees, while being able to carve this up and do any type of alternative sourcing that you can think of. And so when you look at our coalition contracts, we have that with Express Scripts. We have one with Welldyne. We also have one with Optum, CVS, Carelon. And then the PBM contracts that we utilize for our fully integrated groups that are inside of our consortium, those groups are going to get our Welldyne contract, because if you get one high cost specialty drug on that group's bottom line, it's going to have such a big impact that not being able to alternatively source that is going to kill that group's premium spend. And so we want to have a contract in place where we can actually do that, right? Doing any type of alternative funding through patient assistance, specialty sourcing, copay maximizers, international importation, medical channel management, right? And so we're taking the whole broad scale of what is available in the pharmacy space, being able to do that with Welldyne while building it from a framework of a contract that is going to have the best rebates in the country. And so for us, that is a big way that we're driving down spend for our groups every single year. My favorite statistic on this slide is actually the top line. You can see from 2021 to 2022, we've actually gotten better ourselves at doing this, right? Where our PMPM spend for pharmacy was $55, and now it's all the way down to under 50. Why that's huge is because today the average PMPM is 103. So our PMPM spend is over 50% lower, 52% lower than the industry average today, right? And that's because of the specialty cost containment solutions that we're putting into place, all those things that we just talked about. And this is one of my other favorite statistics here, is the prior auth rates, right? So the industry average is around 90%. And why do you think that is? Well, because if a drug can come on your plan and it just gets approved right away, and the carrier owns the PBM, that means that there's no initial way for someone to step in and try to mitigate the spend for that drug. So in our model, through the prior authorization process, instead of just approving that drug, as a prior auth gets filed, we will actually start working with your employees to try and look at getting them into one of these programs. And I like this slide too, because it talks about what our approach to pharmacy is like a waterfall. Everything is going to start with what's going to have the maximum amount of savings. That's always going to be patient assistance, right? So if you're able to get into the patient assistance program, which is income eligibility, you're able to get the drug for free for the employer and for free for the employee, right? And so we can approach that down to an individual level instead of having to turn the drug off on the formulary level. Now, because that's an income threshold, there's going to be some employees that won't meet that eligibility standard. And so when that happens, what we'll do is we'll go down the waterfall, right? And see which next solution is going to have the best savings to the group. And so if we can't get them into patient assistance, maybe we'll lean on international importation. And so in the international importation model, all we're doing is we're working with tier 1 countries, primarily Canada, English speaking countries, that we're able to source those drugs internationally, and then have them sent to forgive me for my lack of knowledge of the geography of Canada, but I think it's Ottawa, that's right above Buffalo. And so we get it done by a specialty pharmacy, and it's the same exact drug. It's being procured in Ottawa, sent over the border about 30 minutes to Buffalo, Buffalo, and then from Buffalo, it's being distributed directly to the door of that employee. Same exact drug, and the only difference is the label, instead of having Spanish on it, is going to have French. So, in that and in that model, we're seeing the average savings for importation around 50% of the cost of the drug. So, patient assistance is going to be 100%. If we can't achieve that, you could do specialty wholesale sourcing, where you're just looking for the same ingredients to be procured at a different pharmacy, right? So same exact ingredients, except a different pharmacy. You source the ingredients, have it made somewhere else. Or you can look at a biosimilar, right? Humira is a great example, where Humira, now that their patent came up last year, you could either collect their rebate, which is now 80% of the cost of the drug. They did that to keep their preferred formulary or preferred status on the big three's formularies. Increase it from 50% rebate to 80%, or you could look at a biosimilar that's going to be a fraction of the cost, right? And so in our model, we're taking all of this into account, and we can do all of this to identify those savings for your groups. But starting at what's going to have the maximum amount of savings and then going down from there. So I'm going to actually stop there, Thomas, because those are really the big three things that I wanted to discuss. And I know that I do want to leave some time for questions here, if there are any today. But I just wanted to stop there and see if there's any questions that people have.
Thanks, JR. I did have questions come through, but they were questions via text and nothing that I couldn't handle myself, and probably stuff that you'll eventually go over. I hope the audience has felt the power behind some of those slides and how misaligned some of the carriers that they're traditionally used to are with their clients, and how Cromdale's doing things different. Kudos to you guys, man.
Yeah, absolutely, man. I really appreciate it, Thomas. And if you have any questions, please feed them through Thomas, and I'm happy to answer them or help at any given time. I appreciate you bringing us in your partnership, Thomas, and I look forward to working with everybody else on the call today.
Awesome. We appreciate everyone's time. JR, very appreciative. Hopefully I won't blow up your spot too much, but JR is also expecting his second child this week, which is super exciting, growing the family. Congratulations, and thank you again. You've been awesome.
Anytime, man. Anytime. Happy to help. Thank you, everybody.
All right. Thanks, everyone. See ya.